All right, let's get right into it. We're going to tackle a question that's at the very heart of the market. Why do stock prices actually change? Let's dive in. If you've ever just watched a stock ticker, it can feel totally random, right? Like some kind of flickering light. But here's the thing, it's not. There's actually a powerful, and you might be surprised, a pretty simple logic that's driving every single one of those little changes.
So here's how we're going to break it all down. First, we'll look at the market's core engine. Then we'll get into what drives demand and what drives supply. After that, we'll talk about the human element, the psychology factor. And finally, we'll see how it all fits together.
Okay, so let's start at the beginning. When you strip everything else away, every single price movement in the stock market, it all comes down to one single fundamental idea.
I want you to think of the stock market as just a giant, global auction that's happening 24/7 in real time. It's not some mysterious black box. Nope, it's just a whole bunch of people and institutions all trying to agree on a price for a tiny piece of a company. That price you see flickering on the screen, that's just the last price that a buyer and a seller shook hands on, so to speak.
And that agreement, well, it's all governed by two powerful forces, supply and demand. It's really that simple. Supply is just how many shares are out there for sale, and demand, that's how many shares people want to buy. The price is just the result of this constant tug-of-war between the two. So let's break that down. It's super simple, really. If way more people want to buy a stock than sell it, what happens? You've got huge demand and not enough supply. The buyers basically have to start outbidding each other, and that competition is what pushes the price up.
And boom, that's what you see here. That competition drives the price up. Up, up, up. It's a really simple concept, but it is so powerful.
Now, on the flip side, what if more people are trying to sell a stock than buy it? Well, now you've got way too much supply and not enough demand. This time, it's the sellers who have to compete. They start lowering their price to try and find a buyer. And yep, you guessed it, the stock price goes down. Okay, so that's the how. That's the mechanics of it. But the really interesting question is the why. What actually causes people to suddenly want to buy a stock all at once? What drives that demand?
Well, demand is almost always about good news and a feeling of optimism. Think about it. A company announces record-breaking profits, or they unveil some revolutionary new product. Heck, even just the whole economy doing great can get investors really excited. They start thinking about the future growth, and they want it on the action. That's what makes demand shoot up.
It's a pretty direct line, right? Good news leads to a good outlook, and a good outlook fires up demand. All right, let's look at the other side of the coin now. What makes a whole bunch of people decide to sell their shares at the same time? What increases the supply?
It's pretty much the mirror image of what drives demand. A company reports disappointing earnings, or maybe there's some scary news about its entire industry. Investors get nervous, they start worrying that the good times are over, and they head for the exits. They sell, and that floods the market with supply. But hey, it's not always negative. Sometimes people sell for a great reason, like they've made a ton of money and just want to cash in on those profits.
But here's where it gets really interesting. Because markets aren't just cold, calculating machines run by spreadsheets. They're run by people. And what do people have? Emotions. And that is the big wild card in this whole equation. This is what people in the business call market psychology. It's basically the collective mood, the vibe of all the investors out there. You'll see times when a stock price moves like crazy, and there's no new report, no big news. It's just because the general feeling about the market has changed.
And this really comes down to two powerful primal emotions, fear and greed. Fear can cause absolute panic selling, right? People sell just because they see other people selling, and it creates this downward spiral. But on the other end, you have greed and optimism. That can create what's called herd behavior, where everyone jumps on a bandwagon, pushing a stock's price way higher than its fundamentals actually support. And that, my friends, is how you get a market bubble. So let's put the pieces together. You've got the basic engine, supply and demand. You've got the fuel, which is news and company performance. And then you have the wild card, human emotion. Let's walk through an example to see how it all plays out in the real world. Okay, let's imagine a popular tech company holds a big event. They announce a revolutionary new smartphone with features nobody's ever seen before. That's the news. Instantly, there's a huge buzz. That's the psychology, excitement, optimism. Investors start thinking, wow, this thing is going to sell like crazy. Their profits are going to be huge. So what do? They rush to buy the stock.
The demand just explodes. There aren't enough sellers to meet that demand, and boom, the stock price takes off. It's a perfect chain reaction.
So when you boil it all down, it really comes back to those three main forces. You have the core engine, supply and demand. You have the drivers, the actual company performance and news. And then you have the wild card, market psychology and pure human emotion, which can just pour gasoline on the fire.
And that's really the main thing to remember. Stock prices aren't random. They're a living, breathing reflection of what millions of people believe a company is worth at any given second. It's a mix of hard facts, data, and a whole lot of human feeling. Once you learn to read those beliefs, you'll start to really understand the market. It stops being so mysterious and, honestly, becomes absolutely fascinating.